Hi, good morning, everybody, and welcome to the February edition. Well, it's really more like a March edition. It's March 9th. I've been a little tardy getting this one out, but February slash early March edition of the markets overview from independent investment advisors. Real quick introductions. I'm Goran Ognjenovic. I'm the founder and the chief investment advisor for Independent Investment Advisors. We're a boutique wealth management firm located in Portland, Oregon. Here's my contact information and our URL. Before I move on, kind of a standard disclaimer here. The following commentary is to be used solely as educational tool, should not be construed to contain investment advice. Investment advice needs to be tailored to particular investor specific needs. None of the information contained in the Market Overview Insight blog should be construed to be investment advice. Individuals wishing to tailor a plan to their own needs should seek an advice of a registered investment advisor. So if you're one of those, please reach out to me and we can have a conversation if we can work together. Also, there's a high degree of risk of investing and trading. We assume no responsibility, and then we may or we may not at certain times directly or indirectly hold positions in securities and derivatives mentioned in this video. Just a reminder, I've had the same slide in our January edition as well. Kind of how it's a reminder of how I think about the markets. Generally speaking, I'm always invested. My portfolios are always investment. We change, or I change allocations, right? The ratios based on market conditions. One of the major advantage of a small firm is that I don't have billions of dollars I need to move through the market, right? I have substantially less than that, smaller portfolios. We can respond based on market conditions. I don't need to anticipate what market's going to do and position my clients. We can wait for a confirmation and then make the portfolio allocation changes we need to without really missing a whole lot of price activity. And then along those same lines, because of that, we can rely on charts and fundamentals and technicals to make those decisions, right? I don't have to anticipate. So moving on, one of the big thing I want to talk about, and if you watch the news in the last couple of weeks, you've seen markets in turmoils and Dow is cratering. I mean, you've seen the headlines, but it highlights the importance of portfolio construction. So it's very, very important, right? It's one of those things nobody talks about when markets are moving up and everybody's making money, but it's a very, very important thing. So a couple of things I want to highlight here because of the portfolio construction, and what this is here is the entire portfolio of my assets under management, right? So this is scaled across all the clients, and on one side of this scale, I have clients with a very long investment horizon, right, 20 years or so. And on the right side of the scale, I have clients that are already in retirement and looking for income. And so, if you're looking at, this sell-off that's happening right now, I think the equity markets, U.S. equity markets, are down like 20%. And my sort of portfolio is, we're down 4% across the entire portfolio. Now, don't get me wrong, right? The portfolios I have with the 20-year investment horizon are far more exposed to equities, right? And that particular set of portfolio is going to be down, closer to where the markets are. But then on the right side, my income based portfolios are going to be substantially up because bonds have moved, and there's been like a huge flight to safety. So, the point I'm trying to sort of talk to here is the portfolio construction is so important, and not only across the asset classes, right? Equity, income, hybrids and things like that, but also across the geography as well as the sectors. And you can kind of see here, right? I like to be really North America focused. So 90% of our investments are in northern, U.S., really U.S. based, and then Europe and Asia, and then fairly diversified across the different industries and sectors. So very, 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 very important, especially in the situation like we're in today, where markets are selling off. All right, let's kind of move on here. So the next thing I want to talk about is got some markings here. Let me erase these real quick. Actually, this is my second time through the video. First time I ended up with the coughing fit right about here, so I didn't erase my markings. So first thing I want to talk about is in the January edition. So this chart is S&P 500, right? 500 largest companies in the United States. It's an index. It's really what I look at. It's the primary thing I look at when I talk about the markets, as in, general statement, right? Generic markets. It's an index. Your Home Depots, your AT&Ts, your Amazons, your Apples, your Microsofts, your Intels. I mean, all of those companies are in here. 500 of the largest companies by capitalization in the United States. And so a couple of things I want to highlight. In my last video, right, we talked about the importance of buying right. So, I talked about instantiating a portfolio here. I can't remember. I think it was either here or here that we added. And then last video I was making, we were sort of right here in January. And I said, I have about 10% more to invest in an equity weight portfolio. And what I was waiting for is a trip down to the 50-day. By the way, these lines, the red is a 50-day moving average, simple moving average, and the black line is 200-day simple moving average. And so as that took place, right, markets came down. I deployed the 10% in cash that we had, and then, just as I expected, they bounced right off the 50-day and started moving higher. So far so good, right? Everything is going the way I was expecting, anticipating. And then I'm going to say, let me erase this again. We have a black swan event. And what I mean by that is we have a couple of things going on, right? We have coronavirus that sort of came out of nowhere, started in China, started spreading, wasn't contained, it's not contained, coming to US. Europe, Italy, right? Milan is being shut down. You got Bill Gates getting on TV talking about this could be the pandemic that we've been waiting for, or we've been concerned about, not waiting for, right? And so markets, of course, start to get soft. Then the other thing you have is, in my January video, I talked about elections in 2020, and in the Democratic Party, you had some candidates that rose to the top that are not considered to be market-friendly candidates, right? And so you had coronavirus, and then you had some additional uncertainty about election, and then what's happening here is, I think I mentioned in my January video, right? This move up prior to this consolidation, I was not thrilled how this sort of happened, right? They just kept buying and buying and buying. There was never really a test. There was never really a consolidation. Like for example here, market sold off and then just bought right away. And so what the setup going into this situation right here is you have, call it 10-15% move in the index, right? Probably more in the underlying companies that put the index together. You have these traders that are now sitting on 10, 15, maybe 20% of profit. And as soon as things started getting soft, they wanted to get out. They wanted to capture that profit, and which is really why you see these super sharp drops, right? The hedge funds, your active traders, they're getting out, and they're capturing their profit. Now, if you're a long-term investor, you really don't care. This is just noise. Right? This is just noise. Again, kind of going back to um, portfolio construction. It is so important, right? Portfolio construction as well as the timing of your buys, right? So if you came to me, let's say you're a new client and you came to me here, say December of 2019, and you said, "Hey, I've got I've got some capital. I want to start to invest." Um, I'd be real. I would have to sit down and think hard how to allocate your purchases, right? How to allocate your investment, because that was definitely not a time to go all in, right? You sort of have to time your entry to the market. If we were having that same conversation a year ago, that would have been beautiful, right? Because we can buy here, we can buy it there, we can buy it there, right? Probably 50% right here, maybe another 20% right there, probably another 20% right there, and then somewhere here, maybe 10%, and you'd be fully invested, which is kind of what I did. I had a couple of portfolios that really sort of follow that path. So if that was the case, those particular portfolios are now sitting on average. Average price is right about here, right? So this move down, the markets are selling off. I'm sitting here looking at this as a buying opportunity. How can I add? Well, I have an incredible opportunity to add to this equity portfolio, at the prices going back to June of last year, right? and I did a couple of those are traditional brokerage account with margin, right? Available. So I ended up actually adding a little bit here, and today's March 9th, which is really what this is. I'm probably going to add here as the day draws to a close. I'll see how this closes, right? So I guess a few points I want to make. One, if you're a longer term investor, this is just noise. It's an opportunity to add to your holdings at really good prices, right? Because markets will bounce back up. It's also this is also one of those moments where if you're not working with a human being, if you're working with a robo advisor, right, or just a generic computer allocation model, the worst possible mistake you can make right now is sell, right? Give in to panic and sell, because the chances are you're gonna be, this thing's gonna bounce and you're gonna miss out on a pretty big move going up the other way. So a huge advantage of working with an advisor, you can pick up the phone, you can call somebody, you can have a conversation, maybe make some minor changes to your portfolio, but you have a team, right? Essentially, it's a team of subject matter experts where you can bounce ideas off of and make changes accordingly, right? All right, I'm going to move on. I guess one more point to this. So the concerns here, right? So I think the first part of this, if I look at this in a timing perspective, I think this right here was a 1 week, and then this was a second week right here. And so what started happening is they started selling here to capture trading profits. But then what we got going on right now, probably sort of in this range in these last 4 or 5 days, is you have substantial impacts to the U.S. economy, right? You have large conferences that are getting canceled. So, people are not traveling, right? Hotels are not booking rooms. You have cruises that are being canceled. So there is this fear of coronavirus is gonna actually filter through, unless it gets resolved here in a short order, right? As and I mean in next week or two, um, it's really gonna proliferate through earnings of a lot of these companies. Travel is about 10% of the GDP, U.S. GDP, right? So it's a substantial component. Airlines are already canceling, they're reducing capacity. This also may proliferate to job loss, right? Companies might start laying off people because they may not have work for them. And then if you're a small business owner, um, if you're a restaurant owner or something like that, right? Your business is down. You're trying to keep your staff. You probably don't have the capital to, weather a huge storm here. So um, there's going to be some impacts, right? That's why I kind of call this a black swan event. Um, it's going to make it's going to dislocate our understanding of the U.S. economy and earnings and things like that, and the markets are adjusting based on that, right? So you can't really anticipate. There's no real way to anticipate a black swan event, especially one that corrects this fast, right? I mean, we got what, one, two, three, four, five, six, seven or eight trading days, to a 15% correction. But if you're a long-term investor and you have the right portfolio allocation and you were buying the right way, it's really a non-event, right? It's an opportunity. All right, I'm going to move on here. Russell 2000, similar picture. So what Russell is, it's another index. Russell 2000 is a subset of a Russell 3000 index. Russell 3000 index represents the largest 3,000 companies in the U.S. And the Russell 2000 is the back end of the 3,000, right? So the companies, so 1001, 1002, 1003, up to 3,000 of the Russell 3000 index. So what's captured here is a lot of small and mid cap organizations. Same kind of thing. Usually you're going to see a larger corrections, right? Because these companies are not as well capitalized as your Amazons of the world. So I would anticipate to see, if the S&P 500 corrects 20%, expect to see 25, 27, maybe even 30% correction on the 2000, right? Similar, very, very similar story. So not a whole lot different to really talk about here. Here's the EFA. This is Europe, Asia, and Far East, right? Excluding China and excluding Russia. So largest companies in Europe, and then and then some of the Asia, and does include Japan, right? So very, very similar story. Here's the reason why I don't. One of the reasons why I really like to be very U.S. weight, right? So there's liquidity issues with some of this. It's not really an emerging market, right? Europe's not an emerging market, but it's not a capital. It's not like a super strong capital market because you have these gaps right here. I mean, look at this, right? If you wanted to get out, you couldn't. There was no liquidity, right? Same thing, same thing here. And so going back to the portfolio construction, you have to participate because you want to capture some of the global growth. You want to capture some of the global dividends, especially when you get into income type things. But you want to construct your portfolio the right way. All right, moving on. So a couple of things I want to talk about, right? So everything so far was equity based, but what about income, right? If you're close to retirement, or already in retirement, you can't afford to participate, you know, in this stuff, right? That's a 20% loss of your essentially, retirement base. You really can't handle that, right? So what you're looking for is you're looking for income, and income. I don't know how else to describe it. I mean, it's a Greek tragedy right now. I mean, the benefit of low rates and low yields is that yes, the houses are, people can buy houses because the mortgage rates are really low and things like that. But for the retirees, this is just tragic. It's a real challenge. So, for example, right? So these are yields. Oops. Um, these are yields, meaning essentially interest that you get back, right? So for a United States 10-year Treasury, right? So it's a 10-year bond, government bond. You're gonna make about a 0.5% on that bond. Um, that's far below the rate of inflation. It's very, really challenging. Now look at this, right? In Germany, they got negative yields, meaning you have to pay the government to loan them money. I mean, this is ridiculous. So the income is really a challenge right now. So what do you got to do, right? I mean, you got to go buy some Brazil, which is not as credit worthy, or you have to go to commercial bonds. Get some, you know, get some debt from S&P 500, right, from Apple or Microsoft or something like that. Or you have to look at some things like hybrid, like REITs, or dividend paying utilities or things like that, right? It's a very, very challenging time for portfolio construction if you're close to your retirement. And then the last slide I think I got for this edition is, as I sit here and I watch this, are we do we have a financial crisis developing on our hands? It's a little hard to tell, but it doesn't look like it. So CDS, credit default swaps, are essentially insurance of what it takes to insure money, right? What it takes to insure bonds. And so this is March 9th. I don't see, one thing I didn't put on this table is this is percent change. This last column is percent change. I don't see a huge move in the default swaps. Obviously, something going on with Europe right here, and then Sweden down here. 4%, 11% move today, and Finland, right? So Northern Europe. I'm gonna sort of assume that has to do with the coronavirus, but I haven't seen a huge move in these. Right, this is kind of one of those indicators that if these things start to get high, is really where I think things can get kind of ugly, right? Because it's insurance for debt owners, right? So if it becomes very expensive to insure debt, meaning that the people that insure debt don't want to insure it, right? Or they're taking on additional risk. This is going to be your telltale that some ugly things might be coming. I don't see that yet. I mean, I see a little elevation as you would expect. So I guess time will tell, right? No change in U.S. UK is very stable. Japan, no change, right? So it's something to keep an eye on as we kind of move forward here. Anyways, I guess that's it. Sorry guys, this took a little longer than I thought it would, 20-25 minutes, but I'm gonna wrap it up right here. I guess my contact info is up on the screen. If you got questions or concerns, give me a call, reach out to me via email, and we can chat about all that. All right. Have a great day.